As the Narendra Modi-led NDA government prepares its first full budget in its third term, investors are hopeful for relief in capital gains taxes. Simplifying long-term capital gains could help investors rebalance their portfolios, while it could help governments ensure better compliance and more tax collections. Take a look at our next report for more on this.
In India, the capital gains tax regime as a whole has grown increasingly complicated for taxpayers in recent years. Reason? The fact that various asset classes have differing definitions for short-term or long-term periods. The Income Tax Act currently taxes gains from both movable and immovable capital assets at varying rates and holding periods. These rates range from 10% to 30%. Experts suggest rationalizing and standardizing the capital gains regime. This can be done by streamlining the holding periods and creating uniform long-term and short-term rates across asset classes. Experts say investors would like it if the holding periods for various capital assets were standardized. This would help increase compliance and less litigation between taxpayers and officials, which is good for everyone. The real question is, will the government avoid drastic tax changes, given the current political landscape and upcoming state elections? Significant changes to capital tax gains seem unlikely. Also, the government is focused on fiscal discipline to boost investor confidence. Media reports quoting sources say the government is likely to postpone the much-discussed changes to capital gains taxes until next year's budget. Bureau Report, WION, World is One.
Now for more on this, we are being joined by D.K. Joshi, Chief Economist, live from Mumbai. Thank you so much for joining us on World Business Watch.
Thank you.
So, now, do you see the government changing the structure of capital gains taxes in this year's budget?
Well, I have no view on the capital gains. I think I can tell you about what the issues in the economy are which need to be addressed. I think we have a very strong macroeconomic environment right now. Growth is higher than expected. Your inflation, food inflation is a problem despite high growth. And I think on top of that, the indicators that have just been released for the first quarter of the new fiscal year, I think they are also pretty strong. So overall, I think the growth momentum remains strong. The external markers are good. And I think where the issue is I think the consumption weakness in the economy, the high food inflation, and I think the climatic-related shifts which are impacting the economy. I think my sense is that the budget will try to address these issues. Until now, budget has focused on creating capex, which it will do, and which has created a very strong growth momentum. Now, I think the focus will also shift towards making sure that the larger part of the population is able to participate in the growth process, and also I think that will help in increasing consumption demand on a self-sustaining basis over the next couple of years.
All right, so on that, just for more clarity on this, I just want to understand what your assessment of the government's divestment targets is.
Well, I think there's no specific divestment target that I'm seeing in the budget. It's not referred to as divestment. I think my sense is that they will create assets and monetize those assets. I think that seems to be the model at this juncture.
All right. Well, so thank you so much for joining us on World Business Watch with all your insights on this.